intentionally ignoring your guts, but I'll try and look into it. So, I appreciate everybody coming. I'm Charlie O'Donnell. Welcome to VC Best Practices. So, first of all, I have a few folks to thank, and you should definitely get a chance to meet up. First of all, the team from Cooley. I think I saw Tim over here. Tim's here. Probably the biggest law firm in New York, venture wise. I don't know how to believe it. Yeah, it's definitely large. And do you want to just give us a couple minutes about?
Yeah, sure.
More about?
Hi, everybody. Welcome. I'm Tim Malloy. I'm Associate Director here at Cooley. I support their business development function. If you don't know Cooley, we're an international law firm that supports the startup and venture capital community through their entire life cycle, both for funds and for emerging founders. Both working in the startup world, we've been posting things like this and supporting the communities, and thanks for joining and partying with us. And if you have any questions, I'm ready for here and the dinosaur shirt, and just let me know.
The folks from Stifel.
We used to CEO. So Stifel Venture Bank works with tech founders, startups, investors for their day-to-day banking needs and global fund banking as well. In addition to that, we support companies on the investment bank side. So a huge hub for markets team as well as wealth management. Yeah, look forward to you all today and meeting some great folks there.
One thing that not a lot of people know about Stifel is they have a whole brokerage and sort of wealth management arm as part of their banks. In the SVB run, where you had a bunch of startups sort of going viral and pulling their assets, Stifel's asset base is actually like really, really diversified for a bank. Because there's a lot of like individual clients and family offices and all that stuff. So in terms of like a real stable financial institution, they're great. And Team King.
I'll keep it short. We're an accounting firm. We provide audit, tax, and advisory services for companies at all levels, whether Series C all the way through the IPO. We also work with funds similar needs.
KPMG's obviously been doing this for a long time in the venture space. And so I've been on a few panels this week, and you will have been asking, like, how do I connect with VCs? It's like, well, if you have an accounting firm who is auditing a lot of these VCs and constantly talks to them about their portfolio companies, obviously they're super well connected. And then we have, I saw Jackie here from Sunset. For those founders in the audience, you won't view this. But if you are on the venture side, an angel investor, and for these small handful of companies that may not be working at Sunset, helps companies wind up. All right, cool. I'm going to have my panel introduce themselves. And they will.
So I'm Rob May. I've been a friend of Charlie's for like 20 years.
2005.
Awesome. And I was very early in investing in AI. I made my first angel investment in AI company in 2015. Investments in AI companies at that time. But I'm currently working on a new startup and have stepped away from the fund that I run as a January and sort of like a partner there. Just happy to introduce you to that and everything else. But I think we have a new show. Charlie was our first guest. It's called AI and NYC. And you can find it on YouTube or Spotify or Apple or any of those things. Our 4th episode just went live today, but if you're doing anything related, it doesn't have to be like, this is not a technical podcast, right? We're trying to get, people from NYPD, who runs data science at the Knicks, like things going on in New York that are AI related across a lot of different industries. So we'd love to have you on, or your friends, or anything else. We shoot down in Midtown at 31st Street and Broadway, and it's a lot of fun. It's very free flowing, so check it out.
Hi guys, I'm Kristen. I'm a partner at EM Ventures. We're a scene stage firm based here in New York. We're 6th fund. We've been around for almost 18 years at this point. So I've seen a couple of the kind of cycles come and go. We're only invested in the scene, so we're super focused to just helping founders get from 0 to 1. We're often the first institutional check into the company. The fund is generalist, but I focus mostly on vertical AI or same things happening in the space right now. So, yep.
And before Venture, I was a software developer product manager. I'm from San Francisco, so back on the West Coast as well as in South America for a couple of years. Then I got my MBA, I went to UC Berkeley, and that was my transition 10 years ago into venture capital. At Big Partners, I've invested at the pre-seed and what we call it deep tech, where there's some core technological risks. And across 10 years, I've underwritten very concentrated portfolios. I've underwritten about 50 investments based on industrial automation, robotics, as well as synthetic biology, meat materials, and spoiler alert, a lot of that touches AI today. So tons of exciting involvement with AI is actually as of a couple weeks ago, I'm starting my own stealth AI startup. So it's fun to really see things on the other side too. So I'm happy to be here.
Speak loud.
Okay.
Okay, cool. All right. So one way to kind of gauge kind of where we are in the cycle, and as you know, venture has always been historically really great at predicting where we are in the cycle, and we never get over our skis, and we're always good knowing when to stop investing. But in the sort of spread between, like, if somebody in the audience here hasn't started putting money to work, or feels like they missed out, would you say it's more like, don't worry, you haven't missed anything yet because we still have a long ways to go? Or are we starting to get the sense that, like, the music is beginning to stop and there are some butts in the seats already and there's sort of limited spaces? So where do you fall on this?
I would say we're at the second at bat in the first inning. I would say you haven't missed anything, and a lot of the stuff that's been built is not going to go anywhere. If you guys have read,
Like, I'm not going to go anywhere like that.
yeah,
Okay.
I mean, if you've read Carlota Perez's analysis, we're in that speculative bubble phase. Most of this stuff is going to die, I think. Part of the reason that I stepped away from investing to do a company is that I actually think there's going to be companies that win at some of the stuff, but it's going to be a little bit random. And I don't invest if I don't have a thesis on why somebody can win and where it's going to go. But some of these spaces, we'll probably talk about the agent space later. I don't think you can predict who's going to win or why. Somebody will, but if it's going to be a little bit random, I don't know how to invest against that. So I think it's super hard. I think you haven't missed anything, particularly if you're at the application layer, the agent layer. I think a lot of that stuff is still being figured out.
Yeah, I would mostly agree. I think maybe I'm a little bit more in the middle. Like, I think there's a couple of things that we've kind of exited the, like, primordial soup of everybody throwing things at walls and seeing what happens. And there's a lot of things, Trout's point, that are probably not going to work out from here. But I think there are some kind of clear vectors or things or strategies emerge that are working. And, like, maybe they're overvalued, maybe they're overhyped, maybe we're overexcited. But I think there's starting to be some categories where it's like, this will generally be a thing. And people are building companies, some of which will eventually endure and bring real value. And there's also starting to be some best practices about, like, how to best bring AI to a market, how to best build apply AI, things like that. That being said, I mostly agree that a lot of the things today will go away. A lot of the modalities will change, like, and just won't even be relevant anymore. And so give it a year and we'll all be talking in space.
So, Kara, on that, you made the decision that your time is better spent building versus investing right now. So I'm curious about whether the cycle and the opportunity played into that at all.
Yeah. Well, I guess I'll start with, I just think there's literally beyond my lifetime, there's never been a better time to build a company. So that was one insight. Having now been in this super cycle for 2 years, I find the hype cycle that I think we are just coming past actually very helpful, because there's, to the point of the primordial soup, there's so much data of what mostly what doesn't work, but a lot of examples of playbooks that are starting to work. So, and I think the other thing is that I think the launcher is changing. I think where value accrues is changing. I think revenue-based financing is becoming a thing. I think seed strapping and effectively bootstrapping is a really different concept. So a lot has changed. And I would say, instead of the music stopping, which I think there's no way that's correct, I think we've changed where we are in the song.
I love being on this house to learn stuff. I've not heard the term seed strat.
Oh, really?
Yeah, that's the first for me. Can you tell me what?
Yeah. So actually, this is funny. So one of our,
I think I might know what it is, but
you probably do, but to name it, one of actually a founder in B's portfolio, super.com, his name's Henry Shee. So he, as far as I know, coined it, but it's the idea of only raising one or small venture rounds and then getting to profitability and being able to support yourself from there. And I mean, kind of the simple, there's a lot that's great about that. But I mean, one thing for founders is you can maintain control and you can build a real business sooner, not one that's based on, like, where you're going, but a real business earlier.
I'm going to say probably raised 5.5.
Yeah.
And took that money and got up to, like, 20 million in recurring revs with 2.5 in the bank. And a PE firm kind of take us off a cap table at, like, 15x, and it was great. It was a great return for us. We still have a little piece in it. They're continuing to build. It's like, has optionality now.
Like, my last investment at B was robotics one 2 weeks ago. It was a $2 million round, and these guys have 600 robots in deployed that they are managing. It's a fleet management company. Compare that to, I don't know, like was a Sanctuary, whatever, like these various humanoid companies, you were $700 million before first revenue. Like there's just a way more efficient way to do it.
That's a big hole to dig down.
Man, can I tell? So one of my best investments and also biggest missed opportunities was something like that. So I was an early investor in a company called Invisible.ai that some of you might have heard of. They automate a bunch of workflows. We got in a $5 million valuation. They got profitable and took out a loan and offered to buy back, because they had raised a lot of money, buy back investors at 60. And I went, well, that's our money. We don't know where this is going. Hell yeah. Somebody reached out to me like 6 months ago and was like, hey, you're an investor in this company, right? They're doing a secondary sale at $450 million valuation. I thought I was super smart for taking my 12x.
Kristen, you mentioned certain parts of the stack and areas, and so I'll start with you. Are there different parts of the market that are ahead or behind each other in terms of either like enterprise or consumer facing or infrastructure? Because it's, we talk about like AI, but it's not a monolith. There's all sorts of different functions, and I'm curious, like, where do you see things being ahead of their skis, or where do you see more opportunity?
Yeah. I mean, I'm biased because I spend a lot of time on the kind of enterprise vertical side, so I'll put that out there. But I think it's kind of become, I mean, I would say it all is kind of a waterfall, right? Like labs and that's kind of the spark of creativity and innovation that feeds everything else. And so by nature, they're further ahead, and that kind of layer is much further ahead. On the enterprise side, I think what I was referring to before is like, there's spaces where it's emerged that you can create value with AI, but you have to kind of, again, back to best practices, you have to have the right guardrails in place. You have the right kind of customer service, right invitation. And so I think there are certain pockets where people have found that you could do that and create a ton of value and are getting a lot of pull. I don't know that it's too far ahead of where it should be though. I think in terms of use case, like valuations maybe, but I think there's a ton of these kind of pockets of work that we're doing today that are fully manual that don't have to be. And there's a lot of really great entrepreneurs who are finding those little pockets and building a ton of kind of structure to be able to use AI in those pockets. And so, yeah, I think on the kind of enterprise vertical side, we're seeing a lot of value come out of it. Sorry. I think consumer is a lot harder. It's like a lot more fickle, and there's a lot less to kind of embed yourself into to create enduring value. So you kind of have a product that comes out, people get really excited, but there's not as much to kind of create moats around. And so as the tech changes, as people decide they're interested in other things, it kind of moves on to the next stuff. Again, I'm biased, but I think there's kind of the most maturity at the kind of enterprise app layer. And it seems like consumer, there's a lot happening, but still to be determined where the greatest value is getting out of that.
Really underwhelmed by the consumers. Yeah, and I think the word that you brought up just in bad to me, it's like a lot of the AI value is when you're already in a workflow somewhere, you already do something, and you have a lot of users doing that, and you sort of figure out how to make it better, faster, cheaper. The consumer stack is super different. For the most part, we spend time with like bigger companies, whether it's like social platforms and stuff, and for all of those offerings, I find it be particularly underwhelming, but I'm open and excited. Well, we mentioned agents, and I'm curious as to like, when you think about like different parts of the ecosystem, where you are, where's your sort of hot and cold?
So I actually wrote a post about it. So I read a Substack called Investing in AI at substack.com, which I've written.
See, now I'm pitching you stuff.
Yeah, I've written it for 7 or 8 years now. And I actually wrote a post. Sequoia came out last summer and said, hey, all the value is going to go to the application layer. And I wrote a post about why I disagree with that. Because if you think about the infrastructure layer that is serving these models, there's so much going on. So Hugging Face has 2 million models now. Right now, most people are going to use probably like 1.95 million of those. So it doesn't matter. They're very niche. But I think what you're going to start to see is a lot of businesses want to serve models in certain ways, right, for their specific needs, and they're going to build a lot of that internally. And so that values, a lot of it's going to accrue. I think there are fewer horizontal opportunities to build application layer software, because people are going to take some of those things that they would have bought before, and they're going to build them themselves in agentic form. And when they do that, the way that you serve these models is like that every layer of the stack can take improvement, right? Like literally the way you load the models into memory on GPUs. Maybe you run them not on GPUs. You run them on like Samba Nova or Cerebras or different hardware. Whether you need them to run faster or cheaper, if you want to batch your jobs, if you need to stream them with this as an AI search application, like the fragmentation that exists there is real. So I think you're going to see 15 or 20 decacore AI infrastructure companies, because serving models, AI inference is going to be one of the largest markets in the history of the world, right? It's going to be.
So you're almost thinking about it the way like when everyone moved to cloud, you had a whole infrastructure map on that.
But it's different because application workloads that are served on the cloud are like relatively interchangeable. Like you might do different joins and stuff in the database, but it's also in the data. But like the way that you want to fundamentally call and run a model has so many different parameters in it. Right? You can make an inference company that just writes optimized kernels, right, for some of these things. I think it's going to be really massive. So I think that's the biggest opportunity. And I think some of the layers in the software set, this is so big, there's always going to be opportunities at every layer. So if I say your layer sucks, like I just mean like in aggregate, looking from an investor perspective, I would make fewer investments there. There's always pockets of opportunities. But I think some of those things that we used to think like at the application layer were really broad horizontal, are going to become very fragmented and hard to
deciding sort of where to build. I'm curious about the different ways to create value at different parts of the stack and where you're focusing on now with your company and whether or not you think you will stay there.
Yeah. Yeah. So even for me, what I think is interesting about the choice I've made, I'm stealth, so I'll speak generally, but I'm actually focused on, AI for the physical world, which is my background, but there's an consumer angle very directly, and it also touches health IT. I agree with everything that's been said about where infra is right now, how, I think that's farthest ahead in terms of like where progress has been made. I think enterprise is exciting. I think consumers are completely lagged because I think you need daily rituals. You need reasons people are coming back. So, yeah, I'll say one more thing that relates to my company, which is I think physical AI is the next frontier that it's about to hit. I think we're at an inflection point there. And I think, and that shapes so much of what I'm doing. I think bridging the digital and physical world, creating feedback loops that often never existed and then therefore what you have a new data source, you have a new way to solve these problems. I mean, I think there's a lot of things that are exciting, but for me, that's probably most.
Yeah, I didn't realize that was this part. Let's talk about the investing side and also fund size and stage as it relates to actually like playing in this space. Because a lot of these companies have raised a ton of money. Somebody mentioned to me the other day that it seemed like teams and stories that haven't built anything yet were raising more money than people who actually sort of build models, was kind of interesting. And so for anybody in the room who is either angel investing or operating at a small fund or doing SPVs, I'm curious how you think about playing in this space with small early checks, and does it require being able to see this all the way through? I'm sure there are going to be recaps and pivots and all of so, or maybe you can just sell into these bigger rounds. Kristen, maybe we'll start with you.
Yeah.
You guys are, what's your fund size? 160. So that's like 0.1 increases or what happened?
Yeah. We're definitely on the kind of more, say, boutique side, which I think is important. But yeah, I would say the fundraising market, just to take a step back, has like totally changed right now. I think a lot of the bigger funds, there's this sense of like category defining companies are getting built right now. And whether the product is there or not, if you win enough distribution, you're going to be able to kind of backfill a product into that category, and you're going to own, whatever it is, customer service or post AI or whatever it is, you're going to own for kind of the rest of time. And all these trillion-dollar companies are going to get formed there. And so my sense is there's kind of a race among the bigger funds to, like, the most important thing is that you don't miss one of these category defining companies. And there's a sense that with enough capital, you can actually kind of anoint a category defining company where, if I give you $100 million at VA, whether you are the total right product or not, like you're going to be able to figure it out because you have so much more capital than everyone else in the space.
You can grab talent.
Exactly. Like it sucks all the air out of the market. And I think that's what happened with a lot of these early breakout companies is people deciding, we're going to anoint you and you're going to grow and whatever. They almost become too big to fail. Like if it doesn't work, well, now we have a lot and we can't afford for this company. And so there becomes this kind of momentum around one or two breakout companies very early. And I think back to the question of story over, product, I think by the time there's a product and it's working, it's too late. And so there's a sense of kind of buying into the team, buying into the vision, and then giving them the capital they need to go execute on that.
How do you play that as a smaller fund?
Yeah, it's funny. So because of that, you see a lot of people like bigger funds kind of coming earlier and making a lot of bets because it's kind of an option fall. I can't afford to not be there when the company starts to work, right? For us, the way we think about it is we kind of have to go back to our roots where it's like, we're not going to make an investment that's the seed. We're not going to make a competitive investment at the seed. And so what we really hone in on is finding a team that is high slope and dynamic enough to navigate the space that they're in. And react to a lot of the market forces that they're going to face, especially even fundraising aside, just the shifts in technology and customer behaviors is so dramatic that if you're not working with a team that is dynamic enough, they're not able to navigate that. And so that's what we prioritize. The contra side of that is we rely on kind of later stage fundraising. We can't be too contrarian, lack of a better way of saying it, because like we're not going to do the A, B, and C. And so there is a sense of like our role becomes helping companies tell that stories, so that they can feed into that kind of narrative of like, we are going to be the ones to own this category. So yeah, that's how I think about it.
So Rob, you've talked about not having a thesis and in areas where you couldn't sort of predict a winner. And I'm curious, like in this vertical, what are the sort of check marks that you're looking for that might be different from like traditional SaaS software or team background and all that sort of stuff? How is the due diligence checklist early on?
I think the biggest thing that's changed from the last week of investing, in my opinion, and the way that we approach it is really the sources of defensibility and the sticky bill. And so you used to be able to look at a SaaS company and kind of if they just got momentum, customer acquisition momentum, you're like, that's a mode, recurring revenue. It's really hard to beat it. It's, and they would be king. We've been in this period where it's really hard to know where the moats are going to emerge. Like I think if you had looked back, like let me give you an example of a contrarian thesis we have. I know we're going to talk about this later, so I'll give you a different contrarian thesis to that one. But GI. So I think when ChatGPT came out, the conventional wisdom was, holy shit, OpenAI is so far ahead of everybody else. And whoever gets AGI first, it's just going to improve itself and extrapolate and run away with it and you own the world. And now I think you look at it and like every quarter, it's like, which model's top? Oh, Gemini's top in Q1. Oh, now Grok in Q2. Oh, Claude in Q3. OpenAI again in Q4. Like they're all going to get, whenever we get to AGI, which I think is the ways away, everybody's going to get there at the same time. And within a year, we are all going to have access to open source superintelligence. That's a thesis I invest against now that I think is a little bit contrarian. But I think people would have thought your lead on the model side would be a source of defensibility. Well, what changed? Well, we ran out of sources of data and lots of other smart people came at it. And there's still, and this is a market that the hardest thing about investing in this market is we could still have major technology discontinuities, right? Most of the world is run on transformer models right now, but there's competitors like state space models and things that like something could come out of left field tomorrow and make OpenAI irrelevant. And that's really scary, I think, when you're investing. And so I think I go back to like both of the other panelists had mentioned like the physical world. We like physical world ideas because VCs have traditionally hated this because, you got to go buy stuff and you need inventory and all that shit. But like, if I have to ship you a thing that has to be made and, AI can't, it's hard for AI to make that irrelevant.
Well, and it's a little sticky too, right? Because you're committed to glasses or a watch or a pin or whatever, and you like one versus another. And the other thing it brings in new data sources too, right? There's so much data about how I go about and interacting and all of what isn't currently being picked up. But whoever actually starts to collect that data, it's now.
Yeah, think about if you put some kind of AI system in this room that's video or monitoring or doing whatever it's going to do, like
Besides the one we have.
yeah, exactly. Do you know how hard it is to rip that out from Cooley? You can't be twice as good or 5 times as good, maybe even 10 times as good. They go, maybe in a year, come back to us. It would be hard.
Yeah, for sure. Kira, I wanted to ask about on the due diligence side, because you talked about like making some hard tech bets. Do you feel like you have to be technical yourself to make those kinds of bets on technical teams or diligence them? And what are some of the ways you...
Because I'm just thinking for myself.
Like how deep did you have to go with bets that you made
Yeah.
where that was not your tech?
Well, okay. So one, personal. I'm a student of life. So in the sense of, I did not study engineering, but I was a software and hardware product manager. I learned a lot that way. But then in terms of, my 2 core theses I mentioned, that let's just pick robotics, which involves with AI. I wrote our thesis helping one of our robotics companies raise their Series A, and she needed help telling her market size story. So I ended up doing a lot of research that turned into like my firm's thesis on robotics and led to other, insights and kind of theses papers. But my point is, I wanted to be able to look myself in the mirror and say, it's more than tech. So when I think about robotics as an example, sure, robotic arms are getting cheaper and stuff like that. But there was, and this is something 5 years ago when I was writing this, there's labor shortage. There was system integrators that are like completely in the way, and that was disrupting how all the innovation rolled out. I think you have to have a really wide view of what's happening to place a solution in context. And so, for any hard tech, and I did synthetic biology in it a couple years before that, and I went incredibly deep on that. The way I got smart, and again, I do think you need to be technical enough to understand a lot. You don't need to be the person that got the PhD, but you need to be able to talk to the PhD and really appreciate their technology. You need to understand the business model that works in those industries. But again, hard tech's a little different because one thing I'd pull out is ROI. And that might sound like this word all investors use, but with hard tech, it's about like output per dollar, and like it's about how your business user would quantify your ROI. And a lot of these hard tech solutions are platforms, but how do they get proven? How do they become the actual platform? They have an application with ROI in one. There's a lot of ways, but this is the way I like a lot. You have one application and then you go to the next. And whether that's a different vertical or it's a different, scale within the same company. But the point is, I think ROI is a really distilled way for the way I think about this tech. And when I say ROI, also what I'm thinking about is what is your hardware cost? Is it $200? Or in robotics, a lot of times it's like $5K to $100K. So then, okay, well then the value I'm delivering has to be that much bigger if it's that much more expensive for me to bring the value. So yeah, I feel like there's art and science to it.
Yeah, and all of this web technology exists in an ecosystem, right? It needs to be sold. There needs to be a decision maker. Like, it's not just, it works technically.
And one more thing, Rob kind of pointed to this, but like the rip and replace concept, I mean, Jesus, that's a lot harder in hard tech. So I think even the bar of ROI or when is 10x is different.
Just in terms of due diligence checkpoints that you maybe overweight or underweight, are there areas that you sort of feel like maybe too much time is focused on, or is there something where you've been spending a lot more time making sure things are checked out?
Yeah, I think the crazy revenue stories we've all been hearing about, like 0 to 10 and whatever, 0 to 2 in 10 days and these sorts of things. Like, I think in general, we've had to discount a lot of those growth metrics where, 2 years ago, equality and also like it's equality, but it's also just kind of the second act is where a lot of the value is. And that first initial spurt of growth is interesting. And if you came to me 3 years ago with that company and be like, this is the most I've ever seen. I mean, now I'm like, that's not really that impressive. What's impressive is what you're doing with that growth, because a lot of this high growth, it comes from these kind of AI, like Trojan horse products where it's like really impressive, really easy to tack on. You just put it on the product and it's like rips. That's not very defensible, and it's very commoditizable in terms of where the tech actually goes. The value, the enduring value in especially vertical SaaS is like, what are you then, that's kind of a entry point to data access that you then use to further embed yourself in the product. And that is proven out by retention. It's also proven out by kind of increasing ACVs and things like that. So that's one thing. The second thing is, honestly, I think a lot of people now that we know what the story is when we go to fundraise, which is like, you have to be, 1 to 10x or don't talk to me. I think there's also a lot of manipulation of revenue numbers where now when somebody tells me, I went 0 to $1 million in 3 months, we'll see if that's really true. Did you like turn it on, on month 1 though, and then kind of like accelerated or whatever? So I think it's a lot of manipulation too. But anyway, all this is to say, I think even real revenue growth is impressive, but the real value is kind of what you're doing in the second act. And so a lot more of our time goes to evaluating how that product is evolving versus kind of what that initial revenue spurt is.
It almost reminds me of the days in like early social where, there'd be like the head of social for Pepsi would sort of trial a bunch of, kind of random things. And like, oh yeah, we'll build in Second Life, or we'll build in this, right? And some of those companies picked up some interesting early revenue, and it wasn't sticky. It didn't come back for renewals, and then sort of moved on to something else. And so there were interesting growth numbers. It didn't.
Exactly. We had a clean due diligence and we had really impressive growth. And when we hit up some of their customers and we asked, like, why did you choose, company A over company B? And they said, we didn't. We're using all of them, and whichever one is best, we'll keep. And I think they ended up using none of them at the end. So just goes to show that it's not, the value is not always there.
So I know for the checks you've already written, obviously you need the later stage funds to come in and mark them up and get them the next $100 million. Just between us, are later stage VCs ruining this market with these $500 million checks or the sovereign wealth funds throwing billions of dollars around.
I think the problem with what's happening of these way the big funds coming earlier is you lose price discipline where you're pricing whatever solution with like high growth SaaS multiples, but you're pricing it under risk. So maybe it's an AI business model, maybe it's like scientific breakthrough in physics, where I think that's really problematic. I will say though, these bigger funds really serve a purpose. I mean, some of the hardware innovation, chip fabs, I mean, you can't do that without a lot of money. So, I think what the healthy reset that I believe we're in these days is more milestone-based financing. And I think this was alluded to, but I think it's just a very different game. Boutique and I think all of us collectively would count on that versus these, decent-sized funds. So yeah, there's big impact.
Yeah, I interpreted your question a different way, right? Which is how the late stage funds impact sort of the overall market. I think they shouldn't exist, and here's why, right? You have these whole problems where people are like, no companies IPO anymore. Would you IPO? But you can go raise $2 billion and stay private. And so the same LPs that write huge checks into Thrive Capital so that companies can stay private longer and they can capture that growth, not the public markets. Those LPs then come to the smaller funds and go, well, there's no liquidity. We can't invest. You guys are returning capital. And you're like, well, all our companies are staying private longer because you guys funded Thrive Capital to keep them private longer. So like the LPs created the problem that they're complaining about, right? Like, and don't realize it. So that's my take on the ecosystem. Yeah.
So I actually posted yesterday. I thought it would get a little more airtime, but I think the other interesting thing that's happening on the LP side is the LPs get paid on markups, not distributions. And people don't necessarily realize this, but when you have like, the person who works for some state pension fund, whatever, they have bonuses basically paid on returns like IRR, not cash back into the portfolio. So if you work for, one of those limited partners and your whole portfolio gets marked up 4, 5, 6x or whatever, and you have these they max out their bonuses. Right. So as much as they don't want a bubble to happen, for example, if you're an early stage VC and you say, oh, we're paying too high a price, I'm not putting the money to work, like that doesn't actually help that. You can go quite a long time with some pretty decent returns as a limit. And when it pops, they don't claw your bonuses back. Right. You still made all of those bonuses. And then, by the way, when it pops for everyone. So it's like, well, I couldn't see this coming. It's not like you have some other development manager that avoided this, right? So there's not a great incentive on the LP side when it comes to Justin, you have a take on the later stage side?
Yeah, I mean, I feel like I kind of hit on it, but I agree with what everyone said. I think, I don't know that it's, ruining the market, I think it's a strong word. Like it just is the market and we have to respond the way it is.
Let me add a question.
Yeah.
What does it do to founder expectations on the early side?
Yeah, it definitely ruins founder expectations. The number of conversations I feel when they're like, well, so-and-so just raised that 500 million without revenue. That's just not how it usually goes. It definitely ruins founders' expectations. I think the problem is we're going to have, and we've seen it a million times before, but we have this huge cohort of companies right now that raise valuations that far exceed any of the fundamental value, in terms of their revenue, but also in terms of the value they might be able to create for customers. And even that is unproven if the product can do what they want it to do. And so I think inevitably there's going to be some kind of a reckoning where at some point the music stops and you're going to have to either definitely be trying to put myself in a position where I was never at the whims of, the bubble popping, all of a sudden I'm done for. Yeah. I think more so the way I think about it is ruining the market, or what I wish it was not doing for market is that it really stifles a lot of innovation because you have 1 or 2 companies that raise a ton of money at crazy valuations and it really dissuades other people going out to market for all the reasons we talked about, the capital as a moat.
So you don't have that healthy competition of somebody else goes forward on a product and maybe I'll come at it a different way.
Exactly. And especially right now, like we're saying, is a lot of the tech and a lot of the approaches we're doing now might not even be relevant to the best ways of going about things. But if we're not encouraging other people to keep investing in those spaces, we'll kind of never know. We'll just be stuck with who's out there today, for better or for worse. So yeah, that's, I think, one of the drawbacks of it.
Well, so I want to go a little bit, not lightning round, but let's just maybe thunder. What's the most, and we'll just go across the board, what's the most overhyped assumption that founders are building on right now? And what happens if they're wrong?
That everybody's going to adopt agents. It's going to be slower than you think. And what happens if they're wrong is, I guess your company doesn't make it.
I think a lot of founders are rebuilding services business right now to be fully agentic, automated. And I think they're going to find that you really can't do it to the degree you need to actually fully replace that service for a customer. And I also think I also think product is going to prove to be, almost as important as distribution, and people who like fight for distribution, but that are not building that.
It tricks you into thinking it's going to be a replacement for something. You get to 80% of what you need so fast. And then you spend the rest of the time trying to file off those rough edges. And that just seems to happen continuously.
I would bet that the vast majority of these businesses are going to end up being human in the loop services business with an AI wrapper for the next 5 to 10 years. And they might still be huge businesses, but I think there's this idea we're going to move straight to that agentic layer, and we're really going to move to, human augmented services for a while before we switch over to that.
Yeah, just to tag on, I think to kind of say the opposite, I think end-to-end task completion requires UX is so strong. So then therefore, general agents, prompt-based solutions, horizontal infra when you don't have a right to win for some of Rob's points. Yeah, that none of those make sense.
If you were to have just an entire category from your deal flow and just not see anything that is and not something that everybody kind of holds, what type of business would you just not want to see anymore?
I would say agents, but I should probably stop picking on the agent things.
Are there any agents in the room?
How about I would say consumer AI probably, right? I think it's still a long way away. I think a lot of the incumbents are going to win those spaces.
I always hate to say this because I say this and I'm like, I never want to see a company like this again. And then the next day a founder pitches me something that just is well, I thought about it like that. That's incredible. This is the most company. You should totally go do this. So, huge disclaimer. I think a lot of the AI go-to-market stack, especially the AI SDR thing, or that, but I think a lot of the AI go-to-market stack, the kind of foundations have been laid. So unless you have a very unique insight into why your approach is different, it's all.
I'm still seeing a lot of foundation model pitches. I think for the physical world, it's a little different because no one's a winner quite yet. But I think the game is already in motion and there's really big players in the space. And when I see those deals, I think the founder typically hasn't been super thoughtful of their.
By the way, the I never want to see a company like this again. I actually think that's a good bar for how you should think about pitching any VC. You go as founders or even investors, you go to all these panels, and I was on one the other day when I'd ask what are you investing in or not investing in, or I couldn't raise because people don't want to do e-commerce anymore. What if no one wants to do the thing you're doing except for yours? That should really be the bar, where convince somebody who says they never want to do another bet just like yours, but actually you've addressed all 4 reasons why they need that space. A couple years ago, pre-pandemic, I had made a bet on a travel company that unfortunately didn't make it through the pandemic, but obviously didn't see that. But when I had written the first check and was syndicating the round out to other people to sort of be co-investors, my pitch to other VCs was you shouldn't invest in a travel startup. Or because travel sucks, except for this company. And I just listed the 5 reasons why you generally shouldn't bet on travel and why this company wasn't one of those things. So feel free to bitch Kristen exactly. But make sure you know why she doesn't want to do that. Okay, 2 more questions and we'll get to the audience. If you had to bet your full Nets fund on a contrarian thesis,
that's my whole personal brand. I think so if you're not familiar with deep AI tech, neural nets are not all the same. There's different types of neural nets, and almost everything today is built on a transformer model. So if I had to pick one thing to double down on, I would say I'm only looking at companies that are built around non-transformer based models, because I think there's going to be disruption there in the future.
I would double down on my product over distribution point with the added point that I think people are underestimating a lot of categories where there are incumbents who are not too old, who are going to be very effective at layering in AI and maybe not providing much value as a net new player, enough to kind of bar people from getting real market share in the space. And so the crosshairs of those two, good distribution, good product, without that kind of competitive incumbent, I think is going to be, there's just going to be a ton of opportunity in the next 2 years.
And when you say product, you mean user experience? What do you mean by product?
Yeah, I think it's again, the difference of going out with that kind of thin AI, whatever wedge and having it rip, and then following closely behind with like building into something's workflows, deeply embedding into kind of, you know, whatever their integrations, their tech stack, pulling in all the data and being able to kind of sit alongside their processes and workflows to eventually be able to automate that.
Feature development, speed.
For sure, feature development and speed, but I'm thinking more in the context of being like, we're so embedded in your workflows and we sit so closely that we actually know how you make decisions start to end. And we can use that process data to actually automate a lot of the work you're doing long term. Access to that kind of data, I think, is like the biggest moat within. And so teams that are thinking about that way and building towards that is, you know, when we talk about the difference between like big revenue and like the company I'm really excited about, it's teams that have like, okay, we have this revenue, we have this distribution, here's what we're doing with it. And it's building into those processes.
Here, besides real world health tech.
Yeah, I was going to say, not to repeat myself. Atoms are great convinced, but to move on, I would say, especially because there's a lot of negative sentiment on consumer, would say on what I think is compelling is the new, so we're talking about embedding into existing workflows. I think consumers are all about the brand new workflows with AI and new tools and things kind of like, they're Monets. They're going to be really different what is successful because a different industry is going to have like what is innovation and transforms, gives you that kind of like unique value proposition to then own a lot of the market. I mean, you're creating a workflow that then if it has a high enough ROI and value, this is a little bit about first mover or early mover, you can gain a lot of distribution.
Yeah, just to double on that, and to be clear, like I'm not barren at all on consumer. I think in the beginning I said I feel like consumer has been lagging enterprise. Like we're on the precipice, I think, of some really interesting consumer breakthroughs. To your point, I think whoever does it first is probably actually going to be, you know, the best kind of opportunity is the one that's a little behind and underinvested in, and there's going to be some breakthroughs here soon. So I think consumer is probably a good contrarian bet.
Cool. We talked about a lot of stuff that like isn't going to work and isn't going to survive. If you found one piece of advice for like surviving the shakeout, what would that be?
I think you got to be at one of the two ends of the financing spectrum. I think you either have to be small capital raised, quick to, you know, at least revenue, you know, if not profitability, which can really hurt in a market that's moving fast and people raise more capital. Like, you know, we sort of glamorize that bootstrapping thing, but like a lot of those companies don't make it and don't win their market. So you have to be careful, or you have to be like too big to fail, right? You have to get enough revenue fast enough, even if you buy it and subsidize it and whatever, and have enough investment in it, if people want to keep you alive, you know, maybe you have to stop growing and you could toggle your business to do that. So I think if you raise up the traditional venture route, it's probably harder. I think you got to be on the ends of the spectrum.
To piggyback off what you're saying, I think you're totally right. I think I would say if I was a venture founder and I was raising venture dollars, I would try internally to straddle the two, which is to say, go big, go for the big vision without losing sight of too much of the value you're creating for the customer today, because that's how you kind of keep from getting stuck when the bubble bursts, is like knowing the real value you're creating and staying close to that while kind of investing in the vision ahead. So stay close to the customer.
Yeah. What's the piece of advice you're giving yourself?
That's a great question. I would say, and actually why I started this company is after seeing, you know, you see thousands of startup deals a year in VC. This is the first time in 10 years that I thought I was made to build this company. Really extreme problem founder fit here. So I think, you know, said another way, what's your right to win? What's your differentiation? I mean, Rob said that's the only way he'll invest. And that is what it took for me to want to.
Let's get a couple of two and three of them down.
Thank you so much for the panel. A lot of interesting insights in the market. So you guys are all investing early stage, right? And you know, in that stage, it's a lot about investing in personalities of founder. Percentage in your investment decision is choosing who to invest in based on personalities. What's the top quality that you're looking for in their personalities? And what's your best practical tip how to identify that quality?
Just in case you were building an AI engine that
One answer is, and I specifically have focused at the pre-seeds. It's first check. So really, you don't have business metrics. So I would put the two variables that I'm always considering are the team and the dream. So like, who are these people and what's the vision? And then on the team side, you know, more specifically, like I like founders through some lived experience, you know, will walk through brick walls to solve it all. I mean, there's a grit, there's a seen this before in this person's life history that really stands out to me.
So a lot of the free models are coming out of China right now, and in the developing world, they're becoming the standard. Long term, so low risk question. Long term, do you think that there is a significant risk to US-based companies to not become the standard in the world?
I just actually wrote a post on this on my thing over the weekend, right? Which is,
Do you have a newsletter, Rob?
I do investinginai.substack.com. No. So, yeah, so I call it, if you guys know, if anyone knows the story of Tanya Harding, if you're old enough to remember that, right? She was an ice skater and she thought she couldn't beat Nancy Kerrigan. So she had somebody break Nancy Kerrigan's legs. And then she got banned from ice skating and didn't get to win. And I feel like that's been our policy with China for this administration, which is like, let's hurt them. More important than like, let's invest and make sure that we win. And the reason that's a problem, this is my concern to your point, is like, if you look what happened with Africa and mobile phones, right? They didn't have landline infrastructure. So mobile phones came out, they had rapid adoption. They surpassed the US in like apps and usage and all that. So I worry if we handicap other countries, they will have breakthroughs that we won't have here. I think that we want to share. We want the rest of the world dependent on our R&D and our path forward. That's my take.
Do you have more founders? And I remember Sam Altman gave advice to founders, and he said that you are really excited about OpenAI's product and feature roadmap and where it's going and how that just bolsters your success. You're building on all business because you're basically saying you're competing with me. So that's my advice. Don't do it.
Yeah, I was just going to say, I think it comes back to like the whole verticalized question is like, is there real value by verticalizing something versus it being, in some cases, yes. In some cases, being in workflow, embedding a lot of, if that's not the case, then I wouldn't do it. If that is the case, the question becomes, is that market that needs a verticalized tool big enough to be venture scale? If it is, you could probably still go raise. If not, you can kind of make the decision around like, do I want to bootstrap this? Is there a lot of value here in what I see? So that's the kind of mental framework I would have for.
If I had to pitch that company, you know what I would do? I would go into VCs and I would lead with this. I'd be like, when OpenAI collapses, we will be like that. I would be that bold. That's the way to do it.
I'll throw one last comment on that too. I think the reason why it can be dangerous is because we're so early in like OpenAI defining like sort of from an application perspective, like what it's good for, trusted for. And it reminds me a little bit about like in the social space when like people were doing like check-ins and on Foursquare, like letting people know where they are. Right. And then Facebook built a competitive product. The problem is that you built your Foursquare social graph based on who would I want to know, who would I let know where I was. You didn't build your Facebook graph that way. It's like some random person you knew from elementary school is like, oh, I don't know. So there was a dependency there and sort of a trust thing, right? So OpenAI, there are definitely certain types of applications where people might not trust it for certain things. And if you can build along those lines and say, hey, here's the reason why this consumer trusted for this or needs this extra thing they haven't built in from the beginning. Maybe there's some regulatory stuff, maybe there's some healthcare stuff, there's privacy stuff there. But other than outside of that, I don't think there's a lot where people sort of define like, this is the only way that I use this. Cool. Thank you so much, everyone, for making the time. I really appreciate it. Thank you for the teams from KPMG, Steve, Pulley, and Sunset for making this whole series possible.
And